What if I told you? You could earn passive rental income from places like Amazon warehouses, luxury casinos, and even cloud data centers without ever owning a single property, no tenants, no construction, no toilets, no permits, no licenses, no 3 a.m. repair calls, and no need for a six-figure down payment. This isn't a dream. It's a strategy used by thousands of smart investors right now through something called real estate investment trusts, or REITs. According to NAREIT, REITs returned an average of 10.6% annually from 1972 to 2022, outpacing the S&P 500 in several long-term cycles. Later in this video, I'll reveal a REIT that pays dividends every single month and has outperformed many popular stocks. But first, are you stuck thinking you need to buy a house to get into real estate? Let's destroy that myth right now. Segment 1. What are REITs? REITs, real estate investment trusts, are companies that own, operate, or finance income-producing real estate. Think of them like mutual funds for buildings. Instead of buying one property, you buy a slice of a company that owns hundreds, maybe thousands, of properties. Retail stores, apartment complexes, warehouses, casinos, and even high-tech data centers. You get exposure to real estate without ever dealing with real estate. According to NAREIT, REITs returned an average of 10.6% annually from 1972 to 2022, outpacing the S&P 500 in several long-term cycles. And today, nearly 150 million Americans own REITs, mostly through retirement accounts. So how do REITs make you money? Segment 2. How REITs generate income. REITs earn income in 3 ways. First, rental income. Tenants like Walmart or Walgreens pay monthly rent. Second, property appreciation. As the value of buildings rises, so does your share price. Third, management fees or interest. Some REITs manage real estate, others finance it and earn interest. As Warren Buffett famously said, if you don't find a way to make money while you sleep, you'll work until you die. REITs let your money collect rent while you rest. Segment 3. Why smart investors choose REITs. So, why choose REITs over traditional real estate? Reason 1. High dividend yields. REITs must legally pay out at least 90% of their income to shareholders. That means you get paid, often. Most REITs yield between 3 to 6%. Some go much higher. Reason 2. Diversification. One REIT can give you exposure to hundreds of buildings across cities, sectors, and tenants. Reason 3. Low barrier to entry. Got $10? You're in. Compare that to a $50,000 down payment on a rental property. Reason 4. Liquidity. REITs are traded, like stocks. Buy and sell them in seconds, not months. Reason 5. True passive income. No broken pipes, no tenant drama, no property taxes, just steady dividends. A 2023 J.P. Morgan study showed REITs outperformed the S&P 500 over 20-year spans when dividends were reinvested. And as Peter Lynch put it, real estate is the only sector where you can be completely passive and still win big if you pick the right assets. Segment 4. Types of REITs. Explained. Let's break it down. There are 2 main types of REITs. Equity REITs. These own and manage physical properties. They make money from rent and appreciation. Mortgage REITs, or M-REITs. These finance real estate by investing in mortgage loans. They usually offer higher dividends, but are more sensitive to interest rates. Want stability? Go with equity REITs. Want aggressive yields? Try mortgage REITs. Question of the day. Would you rather earn passive income every month or own a single rental property and deal with tenant drama? Comment below. Segment 5. Top REIT picks to know. Let's look at 5 REITs delivering real income today. 1. AGNC Investment Corp. A mortgage. REIT focused on government-backed securities. It pays monthly, with a dividend yield of 16.3%. 2. Vice Properties. Owns iconic casinos like Caesars Palace and MGM Grand. offers a 5.5% dividend yield. 3. Prologis owns warehouses used by Amazon and Walmart. 3.8% yield plus long-term price growth. 4. Equinix invests in data centers powering cloud computing and AI. Lower dividend at 2.1%, but strong growth potential. 5. Realty Income, known as the monthly dividend company, owns retail spaces with tenants like Walgreens. It pays a 5.8% dividend and pays monthly. Can anyone do this without prior experience? Segment 6. REIT ETFs for beginners. What if you want to invest in all these with one click? Simple. Use a REIT ETF, an exchange-traded fund that holds many REITs in one package. Top pick? Vanguard. Real Estate ETF, VNQ, holds over 170 REITs. Dividend yield around 4.2%, trusted by over 600,000 investors. With one share, you're instantly invested in malls, hospitals, apartments, towers, and more. Diversified, passive, scalable. How cautious should you be? Segment 7. What to watch out for. But no investment is perfect. REITs come with risks, market fluctuations, prices rise and fall with the economy, interest rate sensitivity, especially risky for mortgage REITs. Taxation. Most REITs dividends are taxed as ordinary income. Use IRAs or 401ks to lower the tax burden. As Warren Buffett says, risk comes from not knowing what you're doing. Segment 8. What are REIT fees? REITs, real estate investment trusts, come with various fees depending on how you invest. 1. Management fees, mainly for private or non-traded REITs. Acquisition fees, 1% to 3% when buying property. Asset management fees, 0.5% to 1.5% annually. Disposition fees, charged when selling property. Performance fees, share of profits if returns exceed a benchmark. These fees are common in non-traded REITs and can reduce overall returns. Second, front-end loads or sales commissions. Non-traded REITs often carry sales charges up to 8% to 10%, which go to brokers. 3. Operating expenses. Cover property maintenance, leasing, legal, and admin costs. Deducted before any distributions to investors. 4th, expense ratios for REIT ETFs or mutual funds. ETFs, typically low, around 0.1% to 0.5%. Mutual funds, higher, up to 1.5%. 5. Trading fees. Public REITs may have brokerage commissions or bid-ask spreads when buying, selling, or REIT fee-type fees. Public REIT ETFs. Low, transparent. Non-traded REITs. High, less liquid. Private REITs. Variable, complex. Now that you know that you can invest in real estate and earn monthly income without buying a property or taking on debt, you're going to need to know the exact steps to choose the right REIT or REIT ETF that fits your goals and risk tolerance. If you don't know vital information, you could pick the wrong REIT, get hit with tax surprises, or miss out on better options. The knowledge is in The Best REITs for 2025, monthly payouts, high yields, and hidden gems, and how to build a $1,000 per month income stream in my next video. See you in our next video.